you said, I believe I have egg all over my face. And I'm wondering now how you feel, whether that egg has now turned into a souffle or where you think we're going now based on that pain we all endured yesterday.
Yeah. Hi, Scott. Thanks for having me. It's been very painful. And I think it's clear that not only is our equity markets really nervous and edgy, but they're hyper sensitive to inflationary data. And I think, whether it's FOMC meeting or even today's payroll numbers, it's really about getting some comfort that inflation's breaking. And from our perspective, it's been really painful. And I don't want to sound like I'm trying to be stubborn, but I just think the risk reward for equities here has improved this week. And I know it sounds glib to say, well, it's, everything's 5% lower, that's why you like it. But number one, on the FANG trade, I just think that multiples are still becoming gifts, especially if we have a soft landing or even a recession, because these companies can grow through a recession. But I think people are overlooking things that are actually forward indicators, because today, for instance, the Manheim Used Vehicle Index came out. It's down to a year-over-year growth rate of only 8%. It was 24% last month. Believe it or not, that in 2 months might take out half a point out of CPI. So I'm kind of more in the camp now that I think we can get some softer readings on CPI. It's not necessarily in the hard data yet, but when it does, I think that's when stocks can really find their footing. Yes, it's been tough.
Is that all we need? I mean, look, it's not like you haven't been a Pollyanna about this either. I mean, you said that the first half was going to be treacherous. That's the word that you used. And if anything, it's been even more treacherous. And I know you expected perhaps that it would be. Do you still stand, though, with your view that stocks are going to have a good second half of the year, knowing what we know about what the Fed is going to do? And might I also add the fact that there's considerable doubt, and considerable is a light way of putting it, that Jay Powell and the Fed can actually pull it off. Right? The bond market is suggesting that, move out of the driver's seat, Mr. Chair. I'm getting in the driver's seat because you don't know where you're driving this car.
Yeah, it's a great point, Scott. Yes, the Fed is only working with blunt instruments, as he says, and the risk is that there's an accident. But the 10-year has been holding at around 3%. Our technician, Mark Newton, thinks that's roughly the high for the year. Keep in mind that when the 10-year's at 3%, I don't think it's demanding to have a 17 PE for the S&P versus a 33 times for the bond market. From 2000 all the way to 2009, the 10-year averaged 5%, and we had an 18 PE for the market. So what has to be calibrated is when investors get comfortable, and I think we're going to get soft readings on CPI. Even today's household employment data was a soft reading. It's half full from my perspective. I think the multiple in equities will actually expand. And from 17, and again, for names like Facebook at 12 times or Google at 13, X cash, or Netflix at 14, they have a chance to even get to a market multiple and they can outperform. So I think there's ballast and underlying valuation support. We know sentiment's awful. We know positioning basically got liquidated. A lot of longs got liquidated and, leveraged longs. And I think now it's just a question of the cadence of data. And if someone thinks the economy is going to get stronger, then there's downside to the market. But I think if things get softer, then I think equities can rally. And again, it's still a treacherous period. It's far worse than I expected. But I'm still sticking with the idea that you really are looking at good risk reward today, even though the market's been marked down.
I appreciate, lastly, I appreciate the contrition from you. Markets are humbling. You find out firsthand, you try and make a call, and they're humbling. Do you feel, before I let you run, that yesterday was the moment, down more than 90%, down volume, and then that follow through? Dow was down 500 or so earlier. It came back. It's still obviously lower, but was that the moment that we should have been looking for?
Well, I like the Lowry's data. Lowry's has always had great data on calling bottoms, and their thing is really a crescendo, which is a 90% down day and 90% of points being down. That's what we did get. The key, of course, is now we need to have a reverse that of a strong day. And maybe if that comes Monday, Tuesday, then I think investors are going to have to respect a move like that. But of course, I just don't know how we end Friday.
Yeah, Fridays are always tough, obviously, to predict in terms of where people want their positioning to be over the weekend. Tom, I appreciate it so much. Thanks for making time for us.